Good afternoon, everyone. I'm Caleb Silver, the editor-in-chief of Investopedia. Delighted to be here with JC Parets, a good friend of the website, the founder of allstarcharts.com, a certified charter market technician, and one of the smartest chartists I know. We're going to be talking about the most important stock charts for 2018. JC is going to take us through that. He looks through about 5,000 charts a week at least. Nobody loves it more than he does, and he's going to share his insights with us for 2018 after an incredible 2017. So we're delighted to have you here with us, but I'm going to refer you just to the disclosure page because this is the disclaimer page. This is JC's research, and JC is an instructor on the Investopedia Academy where he teaches a technical analysis course that I highly recommend. It's great learning. He's a great teacher, but these are not investment recommendations by JC, All Star Charts, or Investopedia.com or our academy. These are his great observations. It's a great place and a time to learn, but invest at your own risk as always. And from there, I give it over to my good friend JC Parets in Sonoma. Take it away, JC.
All right. Can you see that screen all right? I'm seeing it a little bit off. Either way, thank you, Caleb, for inviting me here. To me, it's just such a great experience always dealing with Investopedia. Caleb and I, we always joke, I've been using Investopedia.com since I was in college. I mean, I don't remember not using this. This was, 15 years ago. I'm aging myself. But either way, it's just a great honor working with Investopedia. Happy to do it. I've obviously learned a ton, from not just from my experiences, but from, reading Investopedia over so many years. So it's just a huge honor to share with you a lot of the things that I've learned. So this is fast forward to the agenda real quick. Thank you, Caleb, for that introduction. But I think what we're going to talk about today is technical analysis. And it's not just, squiggly line up, squiggly line down, and support and resistance and all sorts of patterns. It's really about understanding the way that the money is flowing all over the globe. Is it going into stocks? Is it going into bonds? Is it going into precious metals? Where is that relative strength? And then ultimately diving into what individual sectors in the stock market are doing well, which ones are doing poorly. And then breaking it down even further to the individual stock level. So for, let's say, hypothetically, we like U.S. stocks, and within the U.S. stock market, we like financials. Well, within financials, what do we like? Is it the insurance stocks? Is it the broker-dealers? Is it the discount brokerages? Where within financials? It can't possibly be all of them. And by having the asset class, the sector itself, and just the overwhelming trend in our favor is just always going to increase the probability of us being correct. So while we try to be on the right side of the trend, we are also trying to identify what sort of scenario could transpire that will prove that thesis wrong. Where are we wrong? And I think that the greatest benefit of technical analysis is the risk management aspect. How else are you going to manage risk if you're not analyzing price behavior? That's how I see it. So I think it would be irresponsible not to analyze the behavior of the market and market participants, which is what technical analysis is. So why don't we start with the top? We're going to look at the U.S. sectors, and I'm going to show you guys a couple of intermarket relationships. Intermarket means when we are comparing one asset class versus another. Here's a great example where we have two charts at the top. We have the S&P 500 relative to the U.S. Treasury bond market, just very simple, using two exchange-traded funds, SPY representing the S&P 500 and TLT representing U.S. Treasury bonds. And this is really technical analysis 101, this beautiful consolidation taking place over the prior year, and now we are breaking out. And we talk about that in the Investopedia Academy. Caleb is going to share a link with you guys, but I highly encourage you to check it out. I'm basically explaining to you for everything from momentum to intermarket relationships to support, resistance, trend lines, and pattern recognition, all in the Investopedia Academy. But I think these are two great examples, the S&P versus bonds and the S&P 500 versus gold, essentially comparing asset classes versus one another. When an asset is in an uptrend, in this case the S&P 500, sure, everyone knows we're making all-time highs, right? So we are clearly in an uptrend. But what we also want to confirm is that we are also in an uptrend relative to its alternatives, right? When we're allocating assets, what's the question? Do we buy bonds? Do we buy stocks? Do we buy precious metals? Do we buy, where do we want to put our money? And I think that if something is going to be in an uptrend, it should be outperforming on an absolute basis and should be also outperforming on a relative basis. And the S&P 500 is doing that. So this is Dow Theory 101, guys. So you have the Dow Jones Industrial Average, and then you have the Dow Jones Transportation Average. There are 30 stocks in the industrials, and there are 20 stocks in the transports. And this goes back 130 years to Charles Dow in the late 1800s, and really what his concept was, they were railroads back then, not the transports. Now we have things like airplanes and automobiles and all sorts of different things that Charles Dow didn't have in the late 1800s. So nonetheless, it's now the Dow Jones Transportation Average. So his philosophy was, well, you have the industrial average, which are the companies that make the goods, and then you have the transportation average, which are the companies that ship those goods, that deliver those goods. And, that philosophy has just been tremendous over 130 years, and it still works. So when one is making new highs, the company that's making the goods, let's say, you also want to make sure that the company that's delivering those goods is also making new highs, essentially confirming that they're both in uptrends. Or if one is in a downtrend, you want to see the other one making new lows as well, essentially confirming that downtrend. When you see a divergence, like for example, at the lows in 2002, 2003, you had the Dow Jones Transportation Average making new lows still within that bear market, but the industrials were already putting in a higher low. That was a heads up that something was changing. We actually saw it at the top in 2007. You'll notice that the Dow Jones Industrial Average had already peaked, while the transports into early 2008 were making new highs. So that bearish divergence was a warning sign that something was wrong. Sure enough, we had one of the most epic crashes of all time. So fast forward to today, and we have both the industrials and the transports making new highs, essentially confirming one another that they are in an uptrend. So I think that's just a very simple way to shoot.
Sorry, just to interrupt. You always like to say, you reiterate all the time on All-Star Charts, on your service there and in your writing, that these are uptrends, when you see these higher highs, these are signs of an uptrend and there's no real reason to fight it, right?
Yeah, I mean, new highs is just not something we normally find in downtrends, right? I mean, it's just not. So, it's clear that we're in a new high, but to be obnoxiously trying to short, how many people do we know over the last 2 years that have been trying to get short, fighting the uptrend, and have been rolled over because they're fighting the trend. Our job as technical analysts, Caleb, and all you folks listening at home, is that our priority is to identify the direction of the primary trend. That's what we're trying. That's it. There are many different tools that we have, and we're going to discuss those today, but that's our main objective. So here's the S&P 500. Again, beautiful uptrend. In the Investopedia Academy, we go over how to calculate these Fibonacci extensions. It's very simple, really. So I encourage you to go ahead and check that out. But nonetheless, 3,000 is our target. The trade, the investment philosophy, the thesis has been, if we're above 2,400 in the S&P 500, our target is 3,000 from there. So that's about a 600-point ARB, and we're about halfway there. So they're very simple. Nothing goes straight up. So while we've been in an uptrend, we had a nice sideways consolidation. Caleb, we talk about that in the Investopedia Academy when we talk about pattern recognition, where we talk about consolidations in the direction of the primary trend tend to resolve in that direction. So just a great example of an uptrend, consolidation, and then a resolution to the upside, which should be expected, right? It would be the alternative would be unusual. The fact that we resolved in the direction of the underlying trend is perfectly normal, and our target is still 3,000. So
right, and JC says he does bring this up in his great class on technical analysis in the Academy, and we will provide a link to that. I suggest you check it out. But these are great, very distinct patterns that JC is great at pointing out. So I'm sure there's many charts where we'll go through this today. Take it away, JC.
I think the important thing to recognize here is that when it comes to technical analysis, it's not like, we're drawing trend lines and that's the bottom line. As we go through this presentation, you guys are going to see that it's about really incorporating a weight of the evidence approach. It's not just, one magical chart. Hey, JC, I always get asked, JC, if you get stuck on an island somewhere and you only had one chart, what would it be? I guess that question, as funny as it is to maybe think about it, it really does become, I think it misses the entire point. It's not just one chart. It's collectively all of the charts that we look at, right? It's interpreting making a conclusion based on the weight of the evidence. So we're looking at 60 different countries around the world and their stock markets. We're looking at both the indexes themselves, priced in local currency, and then in many cases, U.S. versions of their ETFs of those indexes, but priced in U.S. dollars. So we get kind of like a two-way look at it. Then we break it down to the individual sector here in the United States, and we're looking at between the sectors and the industries. That's another about 140 charts of all different stuff: airlines, industrials, banks, tech, everything. And then once we decide where we want to be, then we break it down to the individual stock sector. So it's about having that weight of the evidence to our back. And then while we're going through each of these sectors, if you're seeing a majority of these sectors making new lows, breaking down, that's a heads up that, in all likelihood, the indexes themselves are probably going to roll over. So what we're seeing today is not that. We're not seeing new leadership to the downside. We're seeing new leadership to the upside. We are seeing new rotation all the time. So the transports are struggling. Now they're making new highs while technology struggles. The railroads and things like that weren't doing very well, while others, now they're rotating. And we're seeing, same thing in healthcare. Biotechnology had its time where it was selling off while others were doing well, and then they started participating again. So I think that the sector rotation, the way I learned it, was that it's the lifeblood of a bull market. And I think that that's what we have here. So when I was talking about the S&P 500, as we go through each one of these, right, it's not just about just the S&P 500. So here we're looking at the Dow Jones Transportation Average, for example, and I still think that we're going to 11,000. So the idea is the primary focus of technical analysis is identifying where the sellers are and where the buyers are, right? So when we see sellers, an overwhelming amount of selling, like for example, here at the end of 2014, you can see this arrow here. That was the high in the transportation average. So what that tells us is that there's an overwhelming amount of sellers relative to the buyers, and then the market sold off. And then once we returned back there towards the end of last year, early this year, we were hanging around that area where there were sellers. So it takes time for the buying demand to absorb all of that overhead supply. And now we have resolved higher and broken out. So it is very clear that there are more buyers than sellers. The upside objective here is 11,100. I think that's where we're going in the Dow Jones Industrial Average. And if the S&P 500, which we just showed here, is going to hit our 3,000 target, and then the industrials are going to hit 11,000, that's probably happening in an environment where more stocks are going to be going higher than those going lower, right? This is a healthy market environment. So then what we did here is we take the Nasdaq 100, traditionally is known as the Qs, QQQ, right? But in this case, we equally weighted it. As we know, there's a lot of technology stocks that their market caps are just tremendous, and they tend to be the stocks that really drive those indexes, which is fine. But in order to get a more broad-based look at what's really transpiring underneath the surface, we want to see what's happening in the equally weighted index. So this is all part of technical analysis, understanding what it is that we're seeing. So when we're looking at QQQ, that's a cap-weighted index. So the Apples and Googles and Facebooks of the world are obviously going to have a much larger percentage relative to something like an equally weighted index where they're all weighted the exact same way in the index. So the fact that we still have upside before reaching our target in the QQEW, which would be up towards 60, the fact that we still have more room really fits in with the whole thesis that we're seeing with both the S&P 500 and the transports. And then while we're on the subject down here, you might notice the momentum down at the bottom, and you see that it never hit oversold conditions. I use an RSI, a 14-period RSI. We talk about that in the Investopedia Academy. And one of the things that we want to look at for strength is when momentum does not get oversold, which is 30, right? Overbought is 70, oversold is 30. When markets fail to reach oversold conditions as they're digesting gains, that is characteristic of an uptrend. That's something bullish. And we talk about that in the Academy, how important that is. And that's exactly what we're seeing here in the QQEW, which is the equally weighted Nasdaq 100. So that is really reiterating that strength, which is essentially saying the same thing that we were already noticing with price itself.
Right. When you say RSI, you're talking about relative strength, right?
I am referring to the Relative Strength Index, RSI, not to be confused with relative strength, which would be one asset compared to another. So before, when we're looking at gold and silver, Caleb, that would be, when we're looking at the S&P 500 relative to bonds, that would be relative strength, right? How are stocks doing relative to bonds? The Relative Strength Index is purely a momentum indicator, right?
Right.
So in this case, we're looking at the Russell 2000. we're looking at the smaller stocks now, right? And there, again, that same theme that there's still upside objective left in the Russell 2000. So I think we're going to approach probably that 1680 or so in the Russell 2000. That's our next extension, right? So all uptrends that we're noticing. And then something that I want to make sure we reiterate is that everything is on multiple time frames. People talk about, some of the benefits of technical analysis. One of the best parts of technical analysis is the fact that we can use multiple time frames. We start with a larger term time horizon, look at a bigger picture, identify the longer term trends, and then work our way down to the shorter term. So here we're looking at the longer term trend. This chart goes back over 15 years, clearly up. We still have upside objectives, and then we break it down to the short term. And for risk management purposes, for execution purposes, for a more tactical perspective, we want to look at the Russell 2000 now on a daily chart as opposed to the monthly chart that we were looking at before to identify the long-term trend. So here, I'm looking at this former resistance, right, the overhead supply right around this 1515 level that we had several months ago. So as far as the trade is concerned, you could look at something like an exchange-traded fund, IWM, futures is the TF that represent the Russell 2000. I think if we're above 1515 in the Russell 2000, which was former resistance a few months ago, so now it theoretically should be support. If in fact it's still in an uptrend, we want to be long only if we're above that. So I think it's a great example of, hey, if we are above 1515, that means that's confirming we're still in an uptrend. But if we're below it, what that's suggesting to us is that no, we are no longer in an uptrend. We are making lower lows and lower highs, and at the very least, we're going to be in a sideways market. Either way, down market, sideways market, either one of those, we don't want to be long. So I think that's a great example of how we use these levels for risk management purposes. So we go chart by chart, and I don't need to explain them all. It's all a very similar scenario. Mid-cap 100, right? So it's not just the large caps. It's not just the small caps. It's the ones in between too, right? It's in between. Then you look at the micro caps. These are the tiny little guys. These are worth less than $200 million. Theoretically, the more speculative stocks, right? The riskier stocks. So when you're seeing the Russell 2000 the Russell Microcap Index making new highs, breaking out of multi-year bases, to me, that's evidence of risk appetite from buy-side institutions. That is bullish. That is characteristic. That is not evidence of a downtrend. That's not evidence of distribution. That suggests to me that the institutions are really digging deep and buying stocks. So the fact that we have so much upside really confirms that. And then you take all those together, the mid caps, the small caps, the large caps, get them all together, and then you bring up the Russell 3000, which essentially represents approximately 98% of all investable assets in the U.S. stock market, and the fact that we are in a very clear uptrend with still plenty of room to go towards that 1800 target in the Russell 3000, to me, suggests that there's still an overwhelming amount of evidence that there is risk appetite for stocks. Stocks are in an uptrend, so we want to be buying weakness, not selling strength, right? So that's the purpose of this. And then getting back to our relative strength that Caleb mentioned before, we want to compare assets. And when we're looking at two assets, we don't just want to compare them like we did before, like gold versus the S&P 500. We also want to think like the investors. Where are the crazy investors going to live, right? What are they doing? And the crazies, they're not buying the S&P 500 large caps. If they like stocks, they're going to speculate on the small caps. Damn it. You're going to get a higher beta. You're going to get more volatility. You're going to get a better bang for your buck, if you will, right? And then silver, same thing. If you want precious metals to go up, you're going to buy gold? No, you're going to buy the cheap one that moves a lot more. So if you want to see where the risk appetite is for stocks versus precious metals, I like the Russell 2000 versus silver ratio. And what we're doing here is breaking out of a nice downtrend that's been in place basically for forever. And now we are breaking out of a multi-year base to new 52-week highs, new decade highs. So to me, that suggests more evidence that money is flowing into stocks, not necessarily flowing into precious metals. So then we want to take the opposite side of the approach. So what happens when stocks get crushed? What happens in an environment, in a risk-on, where they're just saying, get me the hell out of everything, and you get those panics, right? And then the TV people put on the Sunday night specials, markets in turmoil, whatever they have to do to sell their commercials, right? Where does money go when it's coming out of stocks? Well, it goes into bonds, treasury bonds, it goes into gold to a certain extent, and it goes into Japanese yen, right? Because that yen carry trade gets reversed. So that money just flows into those three areas. So what I did was I built an index of all three of those, and then I weighted them based on volatility, right? I adjusted for volatility. And so these three is essentially, if this is spiking, that means that money's really probably the stock market's probably getting crushed. So when we look at this quote unquote safety index that I built, what it suggests is that we're making new lows. So if the safety stuff are making new lows and breaking down, what does that say about where that money is flowing to? And I would argue that it's going to continue to flow into equities. So this is another, checkbox for the bulls in the stock market. And then you break them all down. Look at the correlation between Japanese yen, gold, and U.S. Treasury bonds. And then down below, the safety index that I built. They all look basically the same. There's a very high correlation. And that's part of technical analysis, is understanding which asset classes are going to move together or against one another based on what's happening in other asset classes, right? That's called intermarket analysis. So when we look at something like this, we want to ask ourselves, hey, are these things we want to be buying, or are these things we want to be selling, right? That's the simple question. And to me, breaking uptrend lines in downtrends, to me, we want to be selling these. So if we're selling the safety, what do we want to be buying? I think we want to be buying stocks. So then we look at the London FTSE 100, right? We looked at the U.S., now we look internationally. Look at the FTSE 100 in London. The bottom line is this is one of the most important stock market indexes on the planet. Top 5, maybe top 3. We actually wrote about it on Investopedia.com. I saw Caleb published it yesterday. And I just feel the fact that if the FTSE 100 in London is breaking out to new highs, by the way, it's gone nowhere for 18 years. So when people tell you that the stock market is long in the tooth, or, too far, too fast, too far, or whatever it is that they say, whatever the nonsense is that they talk about, one of the most important stock market indexes in the world did nothing for 18 years. So we're coming out of a multi-decade base. So to suggest that the market is stretched, I think, is irresponsible. And if we start to break out above, that 7,600 level in the FTSE 100, I think that would just confirm everything that we're seeing, that we're probably heading a lot higher, not just in FTSE in London, but really in stocks as an asset class. Then you look at Canada, again, one of the most important indexes in the world. It's gone nowhere for 10 years, guys. 10 years, Canada. And now we're breaking out to new all-time highs. So, again, to suggest that we've gone too far, too fast, I think, again, is irresponsible. So then we would break it down, right? So we're looking at Canada on a long-term basis, breaking out of a 10-year base, and now we take it short-term to focus in on what's really happening. Look down below how momentum never hit oversold conditions. That's a bullish characteristic. The fact that we hit overbought conditions just now in the last couple of months is a bullish characteristic. Think about it. You have people saying, oh, I can't buy it, it's overbought. No. How can overbought be bad? How can an overwhelming amount of buyers possibly be a bad thing? Okay, we want to see overbought conditions. That's a bullish characteristic. We are seeing that, and now we've pulled back, and I think we go higher in Canada. And if Canada's going higher and London's going higher, guess what? U.S. stocks are probably not crashing in that sort of environment. And look at Australia, same thing. Here are the highs in 2015. We just got back there. We've consolidated. If we are to break out and resolve above this, we talk about this in the Investopedia Academy. We call them pennants or flags, however you want to call them. But at the end of the day, they tend to be very consolidation in nature. So they tend to resolve in the direction of the underlying trend. If that occurs, there's something much bigger transpiring where we are now breaking out of a multi-year base in Australia in a very similar way to what we're seeing in Canada, another natural resource heavy sort of space. And, we can make the same argument with Germany coming out of a multi-year base. France, same thing. Notice how this resistance in 2015 is now support, right? So it's not like we're buying France futures or trading DAX futures. It's really just part of the weight of the evidence sort of approach. And just to confirm that, yes, we are indeed in uptrend. Same thing in Belgium. I don't trade Belgium futures. I don't even know there's such a thing. But when it comes to doing the analysis and weighing all of the evidence in equities, we want to include European equities in that analysis as well. And we are just seeing the same thing. And then finally, just from a risk appetite standpoint, think about European banks. If things were about to get real bad, okay, European banks are not going to be breaking out to new multi-year highs. European banks are going to be leading the charge on the way down. So when you look at European banks on both a long-term and a short-term basis, priced in local currency, by the way, it's been very strong. To me, that's just evidence of risk appetite. So when we start to see new 52-week highs, so notice how we're not just saying, hey, we want to be long if we're above this. We're also saying, hey, if it does this, it's going to confirm what we're saying. So we're kind of looking in both directions. We're trying to put together a framework as to what the market's going to look like if we are correct and what the market is going to look like if we are incorrect, right? It's always about what's the risk, what's the reward, what can we see to help us identify that we're wrong, and what can we do to help us identify that we're right, right? So same thing in Japan, just major bottoming processes. We're still not above the highs from the 90s. So again, to suggest that the market is just crazy, I think is irresponsible. We notice how we're looking at Japan, not just priced in US dollars, but also priced in local currency. We want to make sure that when we're looking at these countries, we're looking at it both ways. We don't want the US dollar to dictate what we think about a certain market, right? So again, we looked at the long-term big bottoming process in Japanese Nikkei. Here's the exact same thing. Nice bottoming process, right? Beautiful consolidations along the way. We have now broken out to new highs. We are consolidating, and there's still plenty of room to the upside before our upside objectives are hit up towards 24,000, 25,000, right? Similar in other Asian developed markets, look at Hong Kong breaking out to new highs in a very similar way that Australia and Canada are doing. So if you start to see Hong Kong breaking to the new lows, in other words, not holding above the 2015 highs, that's a great indicator that we're probably wrong on this bullish thesis. We probably don't want to be as aggressively bullish as we have been throughout most of this year. We want to maybe get a little bit more defensive, maybe raise some cash a little bit. And I think if you do see that breakdown in Hong Kong, you're probably going to see it in Australia and Canada as well, right? Brazil, just another great example, just here are the emerging markets, right? Breaking out above a 10-year base. Just now Brazil's breaking out, guys. So again, we're not too long in the tooth. And if we do start to break down and we can't hold those highs, it's probably happening in an environment where Australia and Canada are failing as well. Philippines, same exact thing. And I'm just showing you guys this as just an example about how we're just now breaking out. And if we roll over, it's a great risk management tool. Here's something interesting that I do. When we look at markets, you want to create your own markets. You want to be creative. You want to make sure you're looking at what you want to look at. Make sure you're getting the information that you want to get. So what I did here is that I talk about emerging markets. These are the 6 most important emerging markets in the world. So what I do is I take the 6 of them and I equally weight Brazil, Russia, India, China, Korea, and South Africa. And what I do is I just make an equally weighted index, and it really gives me a good idea as to the direction of the underlying trend for emerging markets, right? Not just these, but really our emerging markets as a group. And the fact that we are breaking out of a multi-year base to new highs, to me, suggests that there's risk appetite in this particular part of the world. So now moving over to the U.S. sectors, now that we have global perspective, now that we have macro perspective, we want to break it down to the individual sector level. And what I see here is, the consumer discretionary space, Amazon represents 20-something%. So to me, to look at a traditional consumer discretionary sector index, well, it's useful, and I do it, particularly with consumer discretionaries. I like to create an equally weighted index. In this case, it's RCD. It already exists. So it's an equally weighted discretionary index and just now breaking out of a multi-year base. So to me, that kind of signals, hey, JC, so all the light bulbs start going off, we should probably look at consumer discretionary stocks, right? So then what do? We look at Amazon. So Amazon obviously still in an uptrend. The trade has been be long if we're above 1,050, and then sell it right around 1,300, right? So that's really been the trade. There have been different trades along the way. As you can see, these different levels. The trades have been, hey, be long if we're above this, take profits here. Be long if we're above this, take profits here, right? So the market really addresses these levels, these Fibonacci extension levels. It really is amazing. And we go over literally every single detail on how to calculate this. It's really like 3rd grade math. It's really simple to do. Yeah. And
hey, JC,
to me, really helps. Right, Caleb?
Yeah, totally. And just some folks are saying they're stuck on some slides. Just do a quick refresh of your browser so you can keep up with us. Folks in the audience, we're on slide 35. I think most people are on keeping up with us, but if you're stuck, just do a quick refresh of your browser. Let's give folks 5 seconds to do that and jump back in. But as JC says, he covers everything from the basics of technical analysis through Fibonacci extensions, which is still pretty basic, into this intermarket analysis, and then looking at these individual stocks and sectors. And you can't just look at one by themselves. You got to look at them in relation to another. So take it away, JC. Just want to make sure everybody's back on board with us, and I think we're good.
Yeah, no problem. I just wanted to reiterate that in that course that we did, we talk about the Fibonacci extensions, and it really is, such a helpful tool. So I encourage everyone to check that out. And then here we're looking at Tesla, and the way I learned it, guys, is the bigger the base, the higher in space, right? So I we don't have a lot of time here today, but I wanted to make sure that I shared kind of to me, some of the most important ways to approach the market when it comes to technical analysis. And I hope I've given you guys a little bit different perspective on things and how we approach the market from a top-down standpoint. And though, again, this goes back to Louis Yamada, which goes back to Alan Shaw, which he learned from his mentor, back in the 1930s. So the bigger the base, the higher in space. And when you see a range-bound market for a long time, the resolution tends to be very explosive. So we have this huge base in Tesla, right, multiple years. We are just now breaking out. We're retesting that breakout level. In other words, that former resistance is turning into support. So I think that we need to be long Tesla all day if we're above those highs from 2014 and 2015. And I think that we're going above, realistically, I think we go above 5.25. That's a long ways away. You're talking 50-60% returns potentially, depending on where you get involved. But the bottom line is, the risk is very well defined, and that's really the most important thing. This is something where we only want to be long if we're above that former resistance, because guess what? If we're not, then that wasn't a breakout, and we are wrong. So why would we be in the stock? So then financials, guys, this just really is, this is the granddaddy of them all. This is the most important sector. We've never had a bull market in stocks without the participation of the banks. And, former resistance tends to be a magnet. And I think that's where we're going. Look at those historic 2007 highs. We haven't even gotten back there. So that's clearly the target. That's where I think we're going. And then here's the broker dealers and exchanges index. This is, when you talk about the Mount Rushmore of most important indexes in the world, the broker dealers and exchanges index is definitely up there. We are just now breaking out above those 2007 highs. You can see it happening in Goldman Sachs in particular. We're going to talk about it in a second. But the idea is if the broker dealers and exchanges index is breaking out above the all-time highs from 2007, it is impossible for me to be bearish of banks. And if that's the case, then it is impossible for me to be bearish of equities. That's just the bottom line. So from a risk management standpoint, it's very simple. If the broker dealers and exchanges index is above the highs from 2007, we do not want to be bearish of banks, and we do not want to be bearish of stocks. It's really that simple. So here's JP Morgan, continues to be in a beautiful uptrend. And guys, you want to talk about market bellwethers, look at a chart of JP Morgan going back 100 years, and look at a chart of the S&P 500 and overlay them. I guarantee you can't tell me which one's which. They look exactly the same. So for me, I like JP Morgan long if we are above the former highs, right? So that stair step needs to continue. So if we are above those former highs from the last couple of months, we want to be long. I think we're going to 115. Here it is on a longer term basis, right? So everything on multiple time frames. If we're above that 90 level from a longer term perspective, 91, we want to be long with a target near 140. So this really boils down to identifying your time horizon. Are you trying to hold this for a long time? Is this a longer term trade? Or is this just a shorter term trade where you want to focus on the more tactical chart? So everything is analyzing things on multiple time frames, right? So here's Goldman Sachs, probably the most important of the broker dealers, really just now trying to break out above those 2007 highs. And by the way, guys, if we're right and this does break out, then we're going to be right on the IAI, which is the broker dealers and exchanges index. And if we're right on that, then stocks are probably going a lot higher, and it's not something that we want to be shorting. So I think this Goldman Sachs chart is very, very important. If we are above those 2007 highs, we want to be long, and I think we're heading up towards 375, 380 in Goldman Sachs, which is still a long ways away. This could be a historic breakout, guys. Look at momentum now getting overbought, confirming that we're in an uptrend. And then of the individual exchanges, these things look incredible, guys. It's just really, truly amazing. We are just now breaking out in the CME group in Chicago, breaking out above the 2007 highs. So I want to show you multiple examples. The Nasdaq also just now breaking out to new highs. Look at American Express. So it's not just the exchanges and the broker dealers, but look at American Express, a very important financial, breaking out to new highs. This looks a lot like Canada. It looks a lot like Australia, doesn't it? It looks a lot like Hong Kong, just now breaking out above those 2015 highs. So to me, what does that suggest? That suggests that if we're going to be wrong in banks, we're probably going to be wrong in American Express. That means we're probably going to be wrong in Canada and Australia and in Hong Kong, right? It's probably going to happen all at the same time, which is why I ripped through 5,000 charts, right? So now, what do we do? We started with the U.S. stock market, worked our way to the global stock market to get an idea of the asset class overall, right? Then we worked our way to an individual sector or a couple of different sectors. We got to the financials. We talked about the broker dealers and the exchanges. Now we're talking about the regional banks. So it's the same sector, different industry. And what I see is something similar. Just now, the regional banks are breaking out above those 2007 highs, right? Giving us a substantial amount of room to our next target. And then I'm going to rip through a few just to show you guys how they all look the same, to show you guys how highly correlated these regional banks are, and other sectors too. This is just the example I'm using today. So here's BB&T, right? Breakout, consolidation, breaking out again. Here's Citigroup, monster uptrend, right? Like what I mean is a base, right? This huge base in Citigroup. The bigger the base, the higher in space, right? Is the old saying. So here's Citigroup. It's very, very simple. We have broken out. We are consolidating. And now I think we break out again. So if we are above $78 in the Citigroup, we want to be long. But if we're below $78, we don't. We want to be neutral. So that's where technical analysis helps identify risk versus reward propositions that are skewed in our favor. Because if we're wrong, if let's say we break out and it falls back below our stop loss and we lose out on this trade, we're only losing a little bit. It's just a little paper cut. But if we're right, we got 20, 25, 30 points to the upside. And so the risk versus reward very much skewed in favor of Citigroup. Now, getting back to the regional banks, look at Fifth Third, right? Breakout, consolidation, breaking out again. Here's Huntington Bank shares, breakout, consolidation, breaking out again. Here's KeyCorp, breakout, consolidation, breaking out again, right? So in the risk versus reward, guys, the idea is always the same. We only want to be long if we're above the former highs. If we're back below the former highs, all bets are off. So from a risk reward standpoint, all of these provide a very similar sort of situation. And these slides will be made available for you guys. So make sure, I know Caleb is going to, if you registered for this, we'll make sure that you get the slides and you'll be able to see the exact numbers from a risk versus reward perspective. So don't worry about that. So PNC, just another great example, breakout, consolidation, breaking out again, right? Charles Schwab, breakout, consolidation, breaking out again. Look at Ameritrade, breakout, consolidation, breaking out again. Are you guys noticing this theme, the same thing over and over and over again? That's why we look through all of the charts, to really identify the direction of the primary trend, because it doesn't become a situation where, oh my God, which one do I buy? It's almost like if you buy any of them, in all likelihood it'll work, or if you buy a couple of them, in all likelihood they'll work, because if one works, then they're probably all going to work, right? So that's really the idea. Oh, JC, but which one do you like? Do you like the Ameritrade or the Schwab or the PNC? It's not so much which one. It's really just looking at them as a group. And then as an investor, you need to identify based on your specific time horizon, risk tolerance, and things like that, which one that you're going to choose, right? But they're all doing great. Look at the interactive brokers, right? So technical analysis is not just about pattern recognition, but really identifying the direction of the primary trend by weighing all of that evidence, right? So what I wanted to do is I want to skip over the technology real quick just to get to gold and silver, because from an intermarket perspective, when precious metals are going up, silver tends to outperform gold, right? If metals are going up, you're going to see higher, the riskier, where there's true sign of risk appetite in silver relative to gold. But if silver's underperforming gold, that historically happens when precious metals are underperforming. So what I did was at the top, you're looking at the silver-gold ratio. And then at the bottom, you have an equally weighted index that I created where it's equally weighted gold, silver, and platinum. So in other words, precious metals. So when the silver-gold ratio is now breaking an uptrend line from those lows a couple of years ago, and now the equally weighted precious metals index that I built also breaking down to new lows, to me, that is evidence of distribution. Those are not characteristics of uptrends. Those are characteristics of downtrends, essentially reiterating that we are still in a downtrend in precious metals. We don't want to be buying gold. We don't want to be buying bonds. We want to be buying stocks, right? Here's a long-term downtrend in gold futures. I don't care who you are. There's nothing about this that is an uptrend. This is a downtrend all day long. So we want to understand that. So I want to present you with a sort of kind of like a question, right? So here what I did was at the top is the US dollar index, and it's inverted, right? So it's upside down. And then at the bottom is gold futures. So the reason there's a negative correlation between gold and the US dollar, right? They move inversely. They move against each other, not together historically. So what I did was I flipped the dollar index upside down just to show you how they do, in fact, move inversely, right? So the two questions are very simple. Is this a bottom in gold and a bottom in this dollar chart, which would classify it as a top in the dollar chart? Is that what this is, or does it look like this? And the US dollar is going to rally, so this chart would fall, and therefore gold would fall as well. In my opinion, in all likelihood, it's probably this one, where the US dollar rallies and gold falls, rather than this one where US dollar falls and gold rallies. To me, this is the outcome that I'm expecting. So we're going to look at this video 6 months from now or 12 months from now, whatever it is, and we're going to see what JC thought. This is what JC thinks, right? But I'll tell you the caveat, right? So where are we wrong? Well, here we're seeing gold futures breaking the uptrend line from last year's lows. So again, not characteristics of bull markets. But I will tell you this: if we start to get above 1,300, if we start to get up here in gold, I would say I'm probably wrong on this bearish gold thesis, and maybe we should look into buying it. But that's not happening right now. We're just breaking uptrend lines. So while I can make a case of what the world would look like in the case of gold being higher, it would be gold above 1,300 would really make me reevaluate this bearish thesis. But in the meantime, we want to be very aggressively bearish of precious metals, right? Here's gold priced in euro. So traditionally, we'll look at gold priced in dollars. Here, we're looking at it priced in euro, breaking the uptrend line from the lows 3-4 years ago. So even priced in other currencies, gold looks weak. So here what I did was I took that same equally weighted precious metals index between gold, silver, and platinum, and I took it back 20 years and I see what this trend looks like. And to me, this is a downtrend all day, guys. And, we talk about it in the Investopedia Academy, this symmetrical triangle tends to be very consolidation in nature. And this is a downtrend. We're consolidating within the downtrend. So we should, what would be perfectly normal would be to resolve, for this to resolve to the bottom. And I wanted to, so from a relative basis standpoint, here's gold versus the S&P 500 making new lows, right? So this is just essentially confirming that not only do we not want to be in gold on an absolute basis, we don't want to be in on a relative basis either, right? There's a lot of opportunity risk there. And then here's gold relative to stocks all over the world, right? This is the ACWI All World Index. And we are making new lows relative to stocks all over the world. So it's not just gold underperforming U.S. stocks. It's gold making new lows, breaking down to new lows relative to stocks as an asset class. And it's doing the same thing against bonds. Gold is breaking down versus bonds. Gold is breaking down versus stocks. These are not things that we want to be buying. And then finally, this is the Junior Silver Miners and Explorers Index. So to me, this is probably the riskiest of all of the precious metal space, right? Like these are the riskiest names. What is the old saying? Mark Twain, a gold miner is a liar standing next to a hole in the ground, right? So this is probably a lot of those guys, but they tend to go up much faster when precious metals and mining companies are doing well, but they also go down a lot faster, because they're fugazi and all that, and, they find out that these stocks are wrong. So they're very speculative. So if precious metals are going to do well, you're probably going to see a breakout to new highs in this ratio as that's happening, not a breakdown to new lows. So to me, we take this as an indication that is really confirming everything that we're seeing. So we could talk about energy. I'm going to leave these charts for you guys. I wanted to save some questions. And I also wanted to show you guys that it's not all hunky-dory. Not everything is great like precious metals. Here are the agricultural commodities. This is DBA and ETF. So this is all of your grains and things like that. Breaking down to new lows, not really something we want to be buying. And then what I did was I equally weighted all of the grains, food, and fiber, right? You can see here corn, sugar, OJ, oats, soybeans, the meal, the oil, right? All that stuff. And there's just no trend. So part of what we do is identify, what the most important thing we do is identify the direction of the primary trend. And in this case, the trend is sideways. There is no trend. So that is part of the trend identification process as well. So I'll leave these guys up for you to kind of peruse on your own before we get to the questions, and just finish up with some cryptos. I know the crypto maniacs out there, they love it. Fortunately, we've been on the right side. We actually talk about it in the Investopedia Academy. It's a couple of examples that we use, Caleb, and then particularly in the Fibonacci, just because these levels have just helped us tremendously. So right now we're stuck in that range between that 11,000 and 19,000 range, and I think that we're going to stay there. And then if we were to fall below that 11,000, we're likely heading probably a lot lower towards 7,400. And if we were to break out above 19,000, 20,000, then we're probably going to 30,000, right? So from a risk-reward standpoint, that's what we want to look at. And we talk about that in the course, very similar to Ethereum and Litecoin. They're all in very similar stages in just parabolic uptrends coming out of consolidations. And while this might be a new asset class, Caleb, tell me this Ethereum doesn't look like a million other things that we looked at throughout the course,
That does not look like a downtrend to me.
And it's like emerging markets in 2014. Come on.
Right.
We've seen these patterns before.
Yeah, and people, when they look at the cryptocurrencies that have been literally, on a tear lately, you hear that phrase, they're parabolic. What does that actually mean when people say that? When they're
what does it mean?
parabolic?
Well, you're looking at it. That's what that's what that means. It's going parabolic. It's going straight up. I mean,
that's hockey stick, right?
Yeah, I mean, you want to know what parabolic is? You're looking at it.
All right. Great stuff. I know we got some questions from the crowd, and folks, as JC has referred, we're going to put this whole presentation up so you can look through each one of these charts individually, see JC's annotations on them, see exactly what he's looking at, and we'll make that available to all folks who signed up for this, and it will be available on Investopedia.com also going forward. And folks, JC does this all the time, all day, all week, every month on allstarcharts.com. He's a great follow on Twitter at All-Star Charts. So all this information is going to be available, and JC is a great sharer of knowledge. JC, I want to hit some questions from the crowd, and we've had a nice crowd joining us today. First one says that you're bullish and they respect the opinion, but this person's bearish due to a lot of reasons. What would make you, JC, turn bearish? A political event or a fundamental thing? And I know what you're going to say because you are a technical analyst, but I want you to say it for yourself. Do you care about the political noise? Do you care about fundamental breakdowns? What is it that makes you say, I'm not so bullish anymore on, let's call it the U.S. equities or banking sector, things that you pointed out in this presentation?
Yeah, listen, that's a great question. I couldn't care less about the political environment. I have my personal beliefs, but I think it's irresponsible to let your political beliefs into your portfolio, right? So I think everyone has a right to have their opinions on what they think is happening in the political landscape. That's terrific, whether you like it or not. But whether you like it or not, we're not in the market to, if you like the situation or dislike the situation, that should not have an impact on your decision making in the market. One has nothing to do with the other, right? So, I'm not betting on the Yankees because of what happened in the Mariners game, right? Or whatever, So they're two completely different things, I think. And then as far as fundamentals, I'm a technician, so I think fundamentals are a waste of time. I get the argument that, listen, JC, it's great to have both a fundamental and a technical approach. That's fine. But for me to waste my time doing fundamental analysis when I could just spend that time analyzing charts, to me, there's opportunity cost in that fundamental sort of analysis. So what you're going to get from me is pure technicals, which is the reason why all the biggest banks in America pay me. Many of the biggest hedge funds are, on all their payrolls, right? And the reason is because they know how pure of a technician that I am, and over half of them are fundamental guys. I would argue even maybe 75%, they're pure fundamentals. So the fact that I can complement the work that they're doing is great. So I have my beliefs, and that's the way that I do things, and most people don't do things the way that I do it. So that's what the value I think I bring is really just a unique sort of extreme price-only approach. And I think that, for me, what's going to make me bearish, I think I laid it out a bunch of examples, Caleb. I told you if Australia fails, Canada fails, Hong Kong fails, the broker-dealers index falls back below the 2007 highs, Goldman Sachs doesn't break out, all of those things would factor into, the safety index not making new lows but start breaking out to new highs. All of those things would be characteristics of what the environment would look like in the case that I am wrong, right? So we want to look for things that will confirm that we are right, and we want to look for things that will give us a heads up that we are wrong, right? So I hope that answers your question. I think I gave a bunch of examples about that, right?
Yep, you did, and folks should just refer back to the presentation because he does annotate that pretty well.
Here's another one. Here's actually another example. Caleb, here, look at lumber futures. This is the S&P 500 on the top, and at the bottom is lumber futures. You can see historically they moved together, and I'll point out what was taking place between 2013 and 2014. You saw the S&P 500, Caleb, was making new highs, but then lumber futures were making lower highs, essentially diverging from the S&P 500. And what happened? That was a warning that the S&P was peaking, and we actually went nowhere for 18 months and consolidated. Well, what happened? Lumber futures and the S&P 500 bottomed out at the exact same time, started to rally together, right? And now the fact that lumber is breaking out above those former highs from 4 years ago, to me, is evidence that stocks are heading higher. So to further answer your question, what would the environment look like if we are wrong on the bullish thesis for equities? Lumber would be back below the 2013 highs.
Right. So you mentioned lumber. You showed some other charts. You showed the financials, which are, as you say, they're leaders. Folks have been asking about commodities. You showed us your wheat some charts around wheat and some of the grains. But in terms of like a key ETF to look at in terms of charting, as far as commodities go, you mentioned gold. Is there one or two in particular you really like? And if you showed us, just refer back to them because folks have been asking about that.
So here what I did was, why don't we talk about oil, right? So here what we're looking at, so when we talk about gold and silver, GLD is the gold ETF, silver is SLV, and you'll be able to see all of the ticker symbols and all of the charts when Caleb sends them to you on the upper left, right? You'll be able to see all the tickers. So the gold miners is GDX, right? So all of those are great ETFs to get involved in the precious metal space. Now, in the oil space, I know there's an ETF USO, if you trade the futures on the CL. But what I like to do is from an intermarket perspective, I take the four countries where I have most exposure to energy: Brazil, Russia, Australia, and Canada, as far as stock markets are concerned. And I want to see how they're doing, right? That's a great indication for oil. And notice how I equally weight all four of those, and now we are above the highs from 10 years ago, right? Just now breaking out above that. So what does that mean? Well, when we look at the oil index, you can see it in blue on top, and then you see crude oil down at the bottom. Notice how they look exactly the same, right? Historically, they move very, very similar. So the fact that the oil countries index that I created is above the highs from the last 10 years, to me is an indication that oil should follow along with it, right? So we look at the oil countries index holding above there, and then here's crude oil, right? So USO would be the crude oil ETF. So I would argue that if we are above those former highs in the oil countries index, we want to be long crude oil, right? And I think that we're going to 62.5. So that's been the target, right? Those were the highs back in 2015. So I want to just reiterate, Caleb, we're talking about commodities, but there's a lot of intermarket relationships that we want to look at, particularly, the oil countries index that I created. I think just a great example of using a different asset class to give you information on something like this in commodities and looking at crude oil, right? But if you move over, look at copper, right? Copper is still in a beautiful uptrend and nothing's changed. And we are above those highs from 2015. So I would argue that if we are above those highs from 2015, we want to be, if not long copper, we want to be buying companies, buying stocks that move with copper. We want to be in base metal-centric sort of investments, right? So we don't necessarily have to buy copper. I mean, sure, you can, no problem. I mean, I do. But there's other derivatives. Copper tends to move very closely with emerging markets. So if copper were to break back below those 2015 highs, that would be evidence that our bullish thesis in emerging markets is probably wrong, right? But if we were to break out above those former highs in copper, I think that would confirm that we were most likely right? So then what I did was I took all of the base metals, copper, zinc, lead, tin, aluminum, and nickel, right? Many of those are in the London Commodities Exchange, and I equally weighted them just to get a good idea as to how base metals are looking. What are base metals doing, Caleb? Base metals, to me, I think are breaking out of a monster downtrend, kind of reiterating that we want to be buying copper. And then just from a risk management standpoint, these former lows in 2012, 2013, to me, are very, very important. It goes all the way back to 2010, right? I think that if we do not rally from here and instead we break below those former levels from the past several years, man, to me, that would be evidence that we're probably wrong on this whole base metal thesis. That means we're probably wrong in emerging markets, and we really need to reevaluate a lot of things, not just how we feel about commodities. So I hope I answered the question on the commodity side.
Yeah, and a lot of people have been asking, why lumber, why commodities, why home builders, why metals, and it's that intermarket analysis. Obviously, if these things are on the rise, you could say, without just looking at price, hey, that's an appetite for building, that's an appetite for manufacturing. If there's an appetite for manufacturing, there's some healthy economic growth going on, and in fact, that's what we're seeing around the world. I'm going to do one more question on Bitcoin, and folks, we'll try to get to, you can always hit up JC on All-Star Charts on Twitter, or join up on allstarcharts.com and listen to his webinars and become a subscriber as well. But folks have been asking a lot about Bitcoin and how to identify when the bubble is going to burst, and how to identify the good crypto coins. That's really hard for anybody to do. There's really no basis underneath these. It's a new sort of alt currency, not based upon anything but this trust. But JC looks at it just from a charting perspective, just from a technical perspective, and that gives you a chance to say, I'm not going to look at why it might go up except for what the price is doing. So for folks that have been asking throughout the webinar, JC, on when would Bitcoin crash or what's the good cryptocurrency to bet on, what would you tell them finally?
It's not so much that there's one to bet on and another one to bet on. I think that the entire space is just here to stay, right? So I think it's the same question, maybe not to that extreme, but the same question is, oh, what stock should I buy, right? Like, there's a lot of different, how do you answer that, right? I don't know what stock you should buy. I mean, there's a lot of stocks that you could buy for different reasons based on different risk parameters that you might have, different depending on what time horizon, like what stock you should buy or what coin you should buy, like for the next 5 minutes or like for the next 10 years, there's a lot more questions that you need to answer rather than just which one do I buy, right? I think that would be irresponsible. I think it's important to identify what the risk would be in a particular coin or stock or commodity or anything really, and then what the potential reward is, right? So whether it's Bitcoin or Ethereum or Litecoin or Investopedia coin or whatever it is, you have to identify what the risk is. Oh, by the way, this goes for any stock, commodity. It's the same strategy. Nothing changes. So what is the risk from where you're going to buy it? What is the potential reward? And is the potential reward exponentially greater than the risk that you are taking? If it is not, if you're just flipping a coin, then I don't know what you're doing here. You're just gambling. You're not investing, right? Those are two different things. We're not here to gamble, right? Go to the casino. This is an investing where we are calculating how much risk and then how much potential reward we can make if we are right. And then if we're wrong, we know what the risk is going to be. We know how much we can lose no matter what. And that's really the idea. So in the Investopedia course, we talk about how to identify those levels, whether it be through trend line and recognition, former support and resistance levels, Fibonacci extensions and retracements. There are many different ways to calculate risk versus reward and then how to express that in a trade. We talk about position sizing, and once you calculate the risk versus reward, how do you know how many shares to buy or how many contracts to buy? We talk about all of that stuff in the Investopedia course, and guys, I totally recommend you guys checking it out. And Caleb, I appreciate the shout out on allstarcharts.com. We're lucky that we can offer a low price because we're scalable. So while we have the biggest banks and all the biggest, many of the biggest hedge funds in the world that pay us for the research, we have a lot of individual investors as well that can benefit from the exact same research. I don't give certain investors some information, others, everybody gets the same thing. So I think it's great. So I really appreciate, Caleb, you invited me over here. If you guys have any questions, I have nowhere to go. So whatever you guys want to talk about.
Yeah, and JC, great point. JC is, like I said, he shares his information, he shares his thoughts. His service is terrific at allstarcharts.com. We have a link to allstarcharts.com, his course on the Investopedia Academy on technical analysis, where he teaches how to understand these patterns and how to really to do the risk-reward analysis and really set up your risk tolerance. Because as JC says, and this is what we believe here at Investopedia, trading is not gambling, investing is not gambling. Gambling is gambling. Trading, investing, it takes smarts, it takes knowledge, it takes training. JC's got a lot of that. And it's not about what's the magic stock to pick. There's a lot that goes into that, and there's no way that anybody, if they're telling you that they know the stock to pick, is telling you the truth, because if they're not using intense research or using fundamentals or technical analysis to really come to their thesis and they've really thought it through, then there's really no point in listening. So I want to refer you again to allstarcharts.com, to the class on the Investopedia Academy for technical analysis. Follow JC at allstarcharts.com. And we really appreciate the time, JC, and the knowledge. And we look forward to the next one. Thanks so much.
All right. Thanks for having me, guys.